everybody. My name is Phil Blancato. I'm CEO and President of Latimer Talman Asset Management, Chief Market Strategist for Osaic. Welcome to another weekly market impact. Wow, it's been a wild week. It's a special Friday edition, by the way. We're going to play this one on Monday, but my friend Erik and I from New York Life Investment Management. I got it wrong. Erik, I'm having a terrible day. We're going to get back to Erik in a second here. I just flew in. Maybe that's my problem. I'm in Aspen, Colorado right now. And the reason why I'm in Aspen, Colorado, we have a conference here. So I was speaking at an event for the next couple of days. The fun part about the story is my older daughter, Luca, gets here today. So we're going to get to ski together for Saturday and Sunday. And then after that, we get into some fun meetings with financial advisors who we're close and very dear friends with. And in just a second, I'll bring Erik on to talk a little bit about a market that I think is fascinating. But before I get to that, I'll have to start off with, usually I start off with something fun. And I talk about my daughters or something fun that I'm doing lately, the puppies at home or whatever. But today I want to shift gears for a minute. I know so many of you are worried about what's happening in the war. And I get that there's so much consternation about it. And certainly it's not my place to weigh in politically if this was a good idea or a bad idea. I know we've talked about, the Iranian regime with some of the atrocities they've done around the world, and the last 47 years. Certainly I get why there's a lot of heartfelt feelings about this. But I guess I'll draw my attention to anytime in war, there's so much worry. The first piece of advice I can give you is don't panic. Markets, as you've seen already, are very resilient to what's happening out there. The U.S. economy is quite strong. For example, today we got PCE out. And you heard me talk a lot about PCE. PCE was for January. We don't have the February number yet. But the reason why I mentioned PCE is over the years that we've been doing this podcast, you've heard me talk about this particular data point a lot. And today it came out right around 3%, to not bore you, 3.1% for core and 3% for headline. Not a big deal, what we would have expected. There's something called super core, which is a little bit higher at 3.5%. We don't show real breakage in inflation, but we're not seeing a real bounce in inflation because of tariffs, and certainly not because of the war. When you strip out the cost of food and energy, and you look at just things besides that, inflation's running at about 3%. And why I mentioned that, for so much that we talk about on this podcast, I always like to keep it to the facts. And will the war be inflationary? Will the war create some sort of breakage in the U.S. economy? It's highly unlikely. Let me give you a short example. Natural gas in the United States is around $3.1 BTU, $3.10 a BTU. If you look at what Germany pays, it's more than double that. Because of the war, it's double that. They've always had a much higher energy cost overseas. So for us, the U.S. consumer, whether you're heating your home or cooling your home or using natural gas for a variety of things, it's not having a profound impact on us. What I think is fascinating is there's been so much talk about gasoline. And yes, you've heard me talk about the benefit of gasoline going down. A $1 drop in gasoline could have the benefit of maybe as much as a couple $100 billion in additional spending by the U.S. consumer. There was an old narrative, a 10-cent drop meant $50 billion. It's probably a little less than that today. Okay, so maybe the U.S. consumer slows down a bit, not out of the question. But it doesn't mean a recession. For example, the number of jobs open in the marketplace came out today. Nearly 7 million jobs are still available in the marketplace. We saw wages still above the rate of inflation. We saw spending above the rate of inflation. So the U.S. economy, by and large, is still in excellent shape. So why I start here is, for all the concern about the war, yes, political, yes, the terrible loss of human lives. So I start off today with, I'll put my two shout-outs today, one on the back, a fun one. But my one up front, I'd start off with say, first, don't panic. Second, the U.S. economy really is in very strong shape. I know there's a lot of concerns about it slowing down. It's just not in the cards yet. I'm going to ask Erik about that in a minute, what it means for municipalities. But it just don't see a lot of breakage yet. You still have this incredible tech sector, but all the other companies in the United States that do better with lower interest rates are also doing quite well. We're not. Is it perfect? No. We saw GDP for the fourth quarter come out today, less than 1%, 0.7. That's not a great number. We expected much higher. But there were things about the fourth quarter, including the government shutdown, that probably caused that, or were led to that, or part of that. I guess my point is, the war certainly is a terrible headline. And watching things blown up is terrible. Most importantly, the loss of human life. And I would say on both sides. I'm sure there's Iranians who are dying in the military. We don't hear about that. But now I believe we're up to, I think it's 13 U.S. military members that have passed away, that have died because of those, 6 that died in the plane crash. And I believe it was, 8 before that. So we're at 14. I hope don't hold me to that. And that's the terror, the tragedy in this, that we have to lose lives over something like this. Will it mean for the greater good? Look, when I look at Venezuela so far economically, Venezuela is on the right track. It went from 900,000 barrels a day to probably 3 million. That's a significant increase. In fact, they're going to produce as much as Iran produces at this pace in a short amount of time. Does it hopefully mean to the benefit of the Venezuelan people did that military situation have very limited loss of life? Yes, absolutely. What's happening in Iran is much different. So for those of you worried about the economics of it, it's just not in the car. In fact, wars are inflationary, not deflationary. Why? Because you spend a lot of stuff on bombs, fuel, jets, all these things. So I wouldn't call it. In fact, one of the best years ever in the history of the market was the bull market of World War II, which started in 1942 and raised in 1943. So it's not about markets. And I know a lot of you listen in the markets, and we talk about a lot of fun stuff on here as well. So I put the Iran situation aside for a minute. And by the way, for those of you who like some of the things I do, we did put out a piece this week, 5 topical things about facts, economics with the war. That's available on osaic.research.com, or just type in Osaic Research and it'll pop up. There's a good video of myself and some of the other guys I work with talking about this. And I'm actually going to start with bringing in my friend Erik here. We're going to start with something fun, but then I want his opinion as well. So Erik, welcome to the call. I'm going to butcher your last name. I've asked you twice and got it wrong. How do you pronounce your last name?
Kazatsky.
Kazatsky. I would have had
Yes.
it. Oh, I would have had it.
You
So I
had
got
it.
it.
It's completely
So,
phonetic. It's easy.
tell me what you do for New York investments. I want to say that
New
I
York
call it
Life
New York Life.
Investment
All
Management.
right,
Yeah.
sorry, New York Life investment management.
Yeah.
I'm
So
being biased.
specifically, it's for MacKay Municipal Managers, which is a boutique as part of New York Life Investment Management, which is our distributor. So that's a lot to remember, Phil. So
But that's the part I remember that you guys are out of this neat little part. We all
yeah,
think New York Life. We're going to think insurance. And
exactly.
why I wanted you to pivot is you do something very different for them. And that's why I was excited to have you on, that the
Yeah.
investment management side of it. And everyone uses this stupid naming culture that we all do. You're a money manager for a really good
Yes.
firm. Tell me about what you do. What do you do for them?
Yes, I'm a client portfolio manager for one of the largest boutiques on the New York Life investment platform, MacKay Municipal Managers. My main job is really to go out and talk to retail advisors and their clients about the municipal asset class, right? Take all the complex things that our portfolio managers are doing on the desk and translate them into easily digestible thought nuggets and, you know, conveying ways that they can have relative value impact on their portfolios, right? Making things really simple.
Beautiful. That's what we do on this podcast. We make it very simple. Now,
Yeah.
for fun, where do you live? You're a Pennsylvania guy, I think, right?
Pennsylvania, right outside Philadelphia.
Skier. I'm out going to be skiing the next couple of days. Do you like to ski? Are you any good at it, first of all? Are you a good skier?
I'm a terrible skier, although
Okay.
we try and get out yearly. I mean, as far as things we do for fun, I mean, watching Philadelphia sports lose, I mean, that has become an annual pastime. So,
Wait a minute. You say that out loud, buddy. You might get strung up in your neck of the woods.
no,
You're
no.
not an Eagles fan, huh?
Yeah, I'm an Eagles fan, Philadelphia
Uh,
Phillies fan. I mean,
oh, I
sometimes
see what you
Sixers
mean.
fan. It depends.
Okay.
But it's interesting. My kids are like 13 and 11, and they have like an abundance of like championship riches. They don't know the
Yeah.
suffering that it is to be a Philadelphia sports fan. So they'll find
Yeah.
out.
I don't know, buddy. You guys are Titletown. You have
Yeah.
had a heck of a run, and you got good owners. I mean, the days of how many millions of people lining the streets to watch a Philadelphia Super Bowl win. I don't know. You guys are going to be fat and happy. I mean, well, good for you. I'm jealous as a New Jersey Giants football fan. Although we got a decent team with it. I love Saquon Barkley, but I'm a big fan of Saquon Barkley. All right,
Yes.
so what I wanted to have you on today was, a lot of times when we think taxes, we get so much, kind of angst about taxes. We talk a lot about them on this
Mhm.
call. And folks are always looking at a way to mitigate them on their stock gains. But I talk a lot about how I think municipal bonds are a fascinating asset class that sometimes
Yeah.
people just forget about. Let's talk a little bit about your favorite asset class and why is it an opportunity right now?
Yeah. I mean, it is my favorite asset class. Spent 25 years in this asset class, and you have to have a
Wow.
lot of love to spend that much time in municipal bonds, let me tell you. Look, it's also the least sexy asset class. And I feel like not only does it get ignored, it just people don't even think about it. You know what I mean? Because there are more interesting options, right? Equities. You strike me
Yeah,
as
I
a
want to go
stock
buy
guy.
Nvidia versus a muni bond from
A
Philadelphia, but I'd
hundred
argue
percent.
there's a value in owning both. Please, sorry, go ahead.
100%. But you know what? I think the opportunity really kind of comes from a lot of this volatility we're seeing spike up. And it's unfortunate it's coming from geopolitical events. But, the fact of the matter is rates are on the rise. And it is an interesting opportunity because, when you tax adjust what you're getting for a muni bond, right, compared to what you're getting in a corporate and then paying taxes on, munis are very attractive, especially when you consider on a risk adjusted basis, right? Munis are much, much safer than a corporate bond, lower default rates, and not a lot of correlation. So when corporates are zigging, munis are going to zag the other way. And that's really what you want to sort of bring down temperature in the portfolios right now.
You said two things I love. First of all, I think what you're trying to say about the income you make, you don't pay any federal tax. You don't, and it's not, you won't
And
pay any
state tax
state
in most
tax.
cases too. Yeah.
So if you're getting a 4% yield, I mean, is that not out of the question, right? There's still some 4%ers out there.
Yeah. I mean, the long end of the curve, certainly you could probably get above
Okay.
that. If you go down
All
a
right.
little bit in the
So
credit spectrum, I mean, you can get as high as probably 8 to 9% on a tax adjusted basis. That's pretty fantastic, right? Think about where you would need to be on a corporate market to get an 8% bond or a 9% bond. I mean, pretty hairy stuff, right?
right. You got to take real risks. So think about that,
Yeah.
everybody. If you put money in with Eric and team, they invested in markets. If they're getting you a yield of 4 to call it 5, make it simple, and you
Yeah.
happen to earn a couple $100,000 a year, your real effective yield is 8 because you don't pay any tax on it, or even
Yeah.
higher. And that's why I think the space is so exciting. But you said something else that I love. You know, at a time of concern, I want your thoughts on Iran versus interest rates and what you think it might or might not do. We'll get to
Yeah.
that next. But, you know, the one thing that you said, it's a safe haven. And I really think it does because most of the time the yields are paid because of some form of tax or revenue. Not all the time,
Yeah.
but most of the time. And you said something I love, which I don't think municipal bonds really ever default. And I know there's been Puerto Rico and Detroit, some weird situation, but I think
Yeah.
a muni bond that yields a lot because it's got maybe not the best rating is kind of a unicorn. So there's because they're safe. Maybe talk a little bit about the safety of a muni bond and where the
Yeah.
money comes from. Where does the revenue come from?
Well, I think the easiest thing to point to the safety is just think about things in terms of historical default rates, right? So over the last 40 years, how often have muni bonds defaulted? And investment grade bonds, things that have a rating of triple B and higher, right, all the way to triple A, they've defaulted 0.02% of the time.
Oh
That's
my God, it's
statistically
nothing.
insignificant. It's
There's,
nothing.
there's the unicorn versus the
Correct.
corporate bond market. I don't know. I think it's close to 20%, if I'm not mistaken. You probably know better than me. What's the corporate market default? I guess the high yield market default rate.
Probably close to that on the high
Yeah,
yield side. Yeah.
yeah.
And I mean, and when you look at the high yield side of the muni market, you're not that much higher than that 0.02%, right? You're probably around 1%. But still, I mean, statistically insignificant to other areas of your portfolio where you're taking more risk, right? So munis really are that sleep at night asset class. Just set it and forget it, get that tax-free income.
Why are they so lucrative right now? And I mean, you think about the outlook for 26. Actually, hold on, I'm not going to go there yet. 'Cause
Yeah.
I think it's a generational opportunity because the yields are very high. I
Yeah.
want your opinion on why they're high. But Iran versus interest rates. I mean, first of all, does you and the firm have an outlook on how maybe thoughts on the wars? Is it a long duration war, short duration
Yeah.
economic impact? Any topical thoughts? I'd love your input there.
Yeah, I mean, like a house view right now, we don't have a house view on how long this is going to be. And it certainly wasn't in anybody's purview coming into 26. Like, we put out our top 5 insights. I guarantee you war was not a factor when we sat down to discuss anything in December. But, here we are. And a lot of the conversations I'm having when I go out and travel with our wholesalers, I'm getting from financial advisors. They're saying, how could we use munis to bring down the risk in our portfolio? Because they're looking at how inflation and volatility is starting to have fissures and cracks in other areas where they have risk.
I mean, that makes a lot of sense. So safety at anchor, the kind of the ballast in your portfolio. But
Yes.
then first of all, why are the yields so high? Let's go there. Why do you think the yields to me, they're higher than normal. They're incredible yields right now, considering what's happening in the regular bond market.
Yeah, absolutely. Well, for several years, what munis are priced off a tax-free curve. And I don't want to go too down the rabbit hole, but corporate bonds, they're priced off the treasury curve, right? Risk-free. So munis have their own risk-free yield curve. And for several years, that yield curve was very flat and inverted. Last year was something interesting. The yield curve normalized. So all of a sudden, you were actually getting paid to take duration and you were getting paid to take credit risk in the muni market, which we hadn't seen in the past several years. So, from a technical standpoint, very exciting opportunity set because you're actually getting paid to participate in a meaningful way. And rates are higher generally because the Fed had been on a hiking path. Inflation is a little here. Now, municipal rates won't move lock in step with treasuries, but directionally they will follow and they are drifting higher. And the higher they go, the higher that tax equivalent yield is going to be, and the more attractive they're going to look. So,
Well, that's a powerful statement because so there you have everybody that's kind of this. I almost thought it was overlooked the last few years, and I don't know if it was because maybe the tax bill was the benefit of lower taxes. Maybe that was part of it. Maybe there was this. I mean, you know better than me. For some reason, it was just not it wasn't a lot of issuance of munis.
Lose
It's
a
almost
lot of issuance. Yeah, I think for what I have observed is that the returns weren't there. Look, when you're getting 20% in your equity portfolio, and I come in, I'm talking to you about getting maybe carry plus or 4.5% in your munis, I'm not really getting you that excited. Let's be
yeah, yeah,
honest.
yeah.
Now, if you have a down year in equities or a softer year, or you're seeing corporate credit spreads widen, you're getting worried about what's happening on the economic front. And I agree with your points you had originally. I'm not saying the economy's rolling over just yet, but certainly if the Fed was on an easing path, they saw something in the tea leaves they didn't love. But look, there is concern there. And look, now is the time when rates are higher to sort of put that little hedge in your portfolio and, like I said, bring down the temperature of risk right now.
So that's the value in this. Not only are you bringing on a temperature of risk, but you're getting a really phenomenal yield, which maybe in the past we couldn't say that, but now we can. So, what's
Correct.
your outlook for this year? I mean, I think these things are a great place to park some money. I would argue if you're getting an 8% real yield or effective yield, I mean,
Yeah.
that means that's incredible numbers. So,
Yeah.
you explain how we got here, but what do you think this year looks like?
I mean, we were very constructive to start the year. And last year, returns weren't fantastic because again, go back to my point about that yield curve readjusting. Returns looked ugly the first half of 2025. You had a lot of retail investors just say, to hell with this asset class, right? We're done with munis. They haven't done anything for us. And if you sold muni bonds in May or June last year, you left like 6 or 7% on the table because they
Yeah,
went on a rip the second half of 2025.
yeah.
So from a technical standpoint, we came into this year on fire. The first 2 months of 2026, munis returned 51% of their 20-year average in just 2 months. I mean, the momentum was fantastic. Now we came to a screeching halt with all of fixed income, as the events in Iran started to unfold. But on a relative basis, we're still outperforming corporates. We're still outperforming treasuries. And it goes back to my point. It is a safer haven, right? Nothing is guaranteed risk free, but it is a place that you would want to be that's going to zig when those other areas are zagging.
Okay, that makes a lot of sense because when I look at, the opportunity set for years, folks thought about this as a safety play. My argument is even if I'm buying the real bond or in a good municipal bond fund, I'm getting the yield and it gives me safety. I win on two fronts, and that's why
Correct.
now it's even more so. What do you say to somebody who lives in a tax-free state? If you live in New Jersey, where I live, Pennsylvania, where you live, we have lots of state taxes. It makes even more sense. But we
Yeah.
have clients. There's people listening today from Texas. Do you
Yeah.
think that's a good idea for a Texan to buy a muni bond?
Oh, Texans love buying muni bonds. Not only that, they love buying Texas muni bonds. I'm telling you,
Really?
they're the fan favorites. There's nothing like buying their own state muni bonds. We have clients in Texas, and it doesn't matter if they're paying state income tax. They just love supporting the infrastructure in the state and the school districts in the state, and it's a sense of Texas pride. But look, you take a state like Florida, it doesn't have an income tax either, right? And the higher rates go, the more attractive munis look at lower brackets. So it only sort of benefits people who don't have an income tax to look at other states or look outside for national type bonds. And when you tax adjust them with rates this high, they still have a benefit. You don't just have to live in California, New York, or New Jersey to get the benefit of the municipal market.
Right. And that's a valuable point for those who live in states you may move to Florida. It gives you advantage besides that. We have
Mhm.
clients in Florida who have
Yeah.
multi-million dollar portfolios and love never having to worry about a dollar in tax regardless of what's happening in their state. And I
Well, they're
think
talking about getting rid of the property tax now, so maybe they'll have an income tax soon. I don't know.
that's a good point.
Yeah.
Uh, when you think about the market itself, who invests in it generally? Is it big institutions or is it more
Yeah.
private investors?
Yeah, huge retail market. Still drives the majority of buying and selling in our marketplace, but definitely an institutional bent to it, especially the last several years. I know it's interesting. We have a taxable portion of our market. Same credit, they just have a taxable wrapper to it, and you have a lot of institutional participation on that side. We have a lot of reverse inquiry from, overseas banks and pensions and insurance companies, and they're looking for US dollar denominated risk, and they're full of private credit. They're full of corporates and they want something uncorrelated. And munis check that box for them.
Understood. That makes a lot of sense. So, different kind of question.
Yeah.
When you think about folks who live in New Jersey or whatever, California, should they only buy bonds or municipal bond funds or whatever that are just from their state, or is there value to looking around the country?
So in some instances, yes, there's value looking outside of those states. Now, obviously, if I was designing a portfolio for a California resident, highest bracket, you're paying up nearly 50% in taxes. So the ideal scenario is to have exposure to California muni bonds. But there are instances where you could look at Texas or Florida, and those bonds will have higher yields. So even after you adjust them for California taxes, there's still a net benefit for looking outside those states. And same thing with New York and New Jersey as well.
Yeah, that's a key point. I've looked at these, everybody, and while I'd love to buy just California bonds, there's times when I can still buy a bond from another state and earn more income because of the price of the California bond. It's such demand because everybody wants it that lives there. And
Correct.
the yield, the price is different, and the yields are different. When you think about what's happening with the Fed, and
Yeah.
we talk so much about the housing market, the regular bond market, the lending market, the mortgage, we don't always think about interest rates and municipal bonds. How correlated are the movement interest rates, or how similar, I should say, or how much are munis affected by what the Fed does? Let me put it that way.
Yeah. I mean, directionally, absolutely. There's a high correlation, but it's not one for one. I think but the correlation right now statistically is about zero point 0.4, zero point 0.5. So, as treasury rates go up or they go down, we're not going to move immediately. Munis actually tend to lag on movements. So as treasuries have been selling off the past several weeks, munis have been inching their way higher, right? Which is a good thing because we can go back and talk about that outperformance in the municipal asset class. Now, you made a good point about the Fed and how that affects the municipal landscape in general. Look, overall, I think lower rates are a good thing from a performance standpoint, but it also is a great call to action to buy bonds right now. Because if you think, like, let's say the war is done and over with several months from now or a month from now or whatever number you want to choose, this administration is going to get back to business. And their focus prior to this had been on getting rates lower. Now, really, their focus is on getting housing costs lower, and that's getting mortgage spreads tighter. But let's just say that they have the right guy in the right seat to help the president get borrowing rates lower. And that's him being active on the front end of the curve, right?
So with the new Fed chair coming in, first, any concerns about him getting nominated? There's a little,
I,
Senator Tillis out there pushing back a little bit. Any concerns
yep.
about him being nominated? And then if he does, yeah, I mean, isn't it a tough job? Isn't it kind of a tough spot to cut rates with PCE, as I mentioned earlier? So it's a little stuck
Yeah,
with
I mean,
rates.
if you want to keep the sense of independency of the Fed, right? They have that dual mandate, and to your point when you started the podcast, right? Employment's pretty full and inflation's in check, right? What's the sort of incentive for them to further cut? And I think that's where they have to strike that fine balance of not getting yelled at by his boss in the press and
Yeah, that's for sure.
kowtowing to that, right?
Yeah.
And sort of trying to help push the economy along because at the end of the day, there's a very important election coming up in November, and everybody is going to start focusing on that in pretty short order.
Yeah, I think for sure the midterms will drive a lot of that. I would
Yes.
assume by then the war is long over, and then more importantly, we have a better feel of what happened with rates and what Kevin's going to do. But in the short term, I think it's going to be challenged. So if you're an investor, someone listening
Yes.
to this podcast, should they be buying? And I guess it's a little bit personal, but if they were trying to get maximum yield or return, would they buy munis that mature in 3 years, 5 years, 10 years, or a blend of all?
Yeah. No, I mean, the best value that we're seeing is in the longer end of the curve, right? And people, when I say that, they think about a 30-year muni. And the way the yield curve shaped, I don't need to buy a 30-year muni. I could get 95% of the benefit in 20 years. That's the great part of the muni market. I don't have to go out really long to get the max yield. For us, looking right in that 12 to 22-year area of the yield curve, that's really the sweet spot. You're getting most income, all the carry and roll down that's going to help total return. And it's really where we've had the most success as an asset class over the last 7 months.
Okay. So for everybody who's listening, first of all, it's why I hire New York Life Investment Management and the team here and Eric and guys, but because they'll manage that for you. But
Yes.
I do think there's some value in thinking about if I was going to maximize my opportunity, it sounds like bonds are going to mature 10 years or even more would be a great spot. The real bond or a bond mutual fund? Does it depend on how much money you have? Or would you prefer folks buy the real bond through you all or a bond mutual fund or ETF? What do you think? That's the right way to get involved in this
Yeah.
asset class.
Look, I'm a traditional individual bond guy. I grew up in public finance investment banking and doing underwriting. So, I mean, it was interesting for me to fully convert and drink the Kool-Aid of the commingled product. But I'm a huge believer now of how efficient it is. I love mutual funds. But look, as a lot of RIA aggregators come online, they've gravitated toward ETFs because they fit into models better. And they're a little bit cheaper and they have intraday liquidity versus daily liquidity on a mutual fund. They're both great. It just depends on what flavor you need. They
Yeah.
both do the same thing, right? They're delivering tax efficiency and they have credit diversity and you have an active management overlay that's going to help you get a great return.
A little bit about your firm. Do you guys provide products, excuse me, that fit this sort of narrative? Can you do both?
Absolutely. We do mutual funds and ETFs, and we have products that fit every area of the yield curve you could be looking at. If you have clients that are sitting in cash, we have a solution to get them out of variable rate products that are getting reset lower or T-bills that are maturing and, put them in the front end of the curve 2 years, just a little bit of duration. We can get them about a 6% tax equivalent yield. Pretty incredible, right?
Wow, that's incredible. That is.
Yeah. I mean,
You
there's
think
an
about this,
opportunity set. Yeah, definitely.
and you beat me to it. Everybody who's in money markets right now, and you enjoy these wonderful yield rates, have gone down. We think they're
Yes.
going to slowly go down over the next couple of years. So why not shift to a higher yielding portfolio and make it tax free? And
Yeah.
by the way, not very risky. I mean, I think that's how I would surmise it.
Yeah. And I look a lot of clients who've been sitting in cash or cash equivalents. It's been warm and cozy the last several years and a great place to hang out. And they don't want to necessarily buy a 20-year bond. So that 2-year portion where we have a short-term fund, it's been a great alternative for them.
Well, if they did put a 20-year bond, and we're right that interest rates go lower, the price of their bond is going to go higher because it's going to be
I
more in demand,
I
and you
understand
could
that, but one
you might
step
be
at a
able to
time.
sell it
Let's get them on the
one
yield
step at a
curve
time.
first.
Let's get them out there first. I would agree with you.
Yeah.
So let's sum this up. If you wouldn't mind, if you were talking to, I don't know, your mom, and you want to explain the summary of this, what would you want folks to take away from this podcast today?
I would say that, look, in an environment that you had a lot of surprises right out of the gate that no one were anticipating in 26, the temperature's hot in a lot of portfolios, right? Risk in areas you weren't even thinking about 2 months ago. How do you bring that temperature down? Municipal bonds are a great way to hedge some of that risk that you don't have to sell things that necessarily might be sitting at a little bit of a loss right now. You could layer in a little bit of a hedge, bring down that risk profile, and get income that, like you said, is a generational opportunity because rates have not been this high in many, many years.
Yeah.
And that really is the opportunity set in a nutshell.
So why I was so excited about Eric joining me today, everybody, was he hit on it. But I think sometimes we get so lured into, let's go buy stocks because they've had a great 10-year run. Let's go buy
Yeah,
more Nvidia. And think about it, the stock market's not up for 5 months. You know what is up over the last 5 months? Municipal bonds. They
that's
give you a
absolutely right.
great income. They pay you. They're safe. And by the way, if you can get a real yield, I'm sorry, an effective yield, or I'm saying this wrong. If I can earn you 5%, but you don't pay any tax, it's worth 8. Simpler put, then you just got an 8% rate of return. You know what the average return of the stock market is the last 100 years? It's 8%. So you're getting equity like stock market like returns in a very safe portfolio. And
Yeah.
that's why, to me, it's a really opportune time to do this. So this has been exciting. Thank you, Eric. I've enjoyed you having you on today. Now we're going to do some fun
Thanks,
stuff.
Phil.
If you had to give me a shout out, something fun, it could be anything you want. It could be anything you want.
Yeah.
I like to do my shout out. I start off with a little bit of the poor folks that are fighting this war for us and
Yeah.
those that passed away. But I've got a fun one to end up with. What do you have for me? You got one for me? Can't be. Don't say the Philadelphia Eagles. They
No,
didn't
it's not
win.
going to be the Philadelphia Eagles. There's one thing that's on my mind, and that is my son's championship basketball game tomorrow. His
Oh,
team went from last place to first. And so he is beyond excited. So tomorrow, I'm giving a shout out to him and his team. They're going to kill it. I'm
how old is
absolutely
he? How
pumped.
old is he?
He's
What's
11. He's 11.
awesome? What's the
Yeah.
name of it? That's the team's name. We gotta know. We got to follow up. What's the team's name?
I know. The yellow team. They go by colors in my
Yellow.
district. I know.
It's okay.
Team yellow.
You have to let me know
I
how they
will.
did it, and I'll let the
I
folks on the
will.
podcast know the week
Yeah.
after.
It's
That's a good shout
Cinderella
out.
story, Phil. From
I
from
love it. I
yeah,
love it. That's fun. I was the baseball coach for many, many years, and we had
yeah.
one year, my last year coaching, we had on the team 6 girls
Yeah.
and 8 boys. So
Okay.
we went to the championship and lost on the last play of the game. So, and we went from worst to first. It was a lot of fun. My shout's a little bit different. As you know, I tend to do a lot of sports stuff. I'm trying to mix it up, some serious, some sports stuff. But I gotta give this one sports this week. I can't help myself. Don't get mad at me. I know some people on this podcast are gonna get mad, but mine is the tip of the hat to the Italian baseball team that beat the United States, beat Mexico, undefeated in round robin play, a shot of espresso after the home run, a glass of wine into the locker room, a kiss on both cheeks. I mean, come on, if you're not enjoying this for the kids that no, granted, they're born American kids, so they're born playing baseball in the United States, obviously. But I think it's great fun. And by the way, it's big in Italy. They're tuned into it. It's on national TV out there. They're very excited about this. The head coach drove 15,000 miles last year trying to find kids who could play on the team long term. So baseball in Italy is happening. The soccer team is not very good right now, so maybe it's going to tilt to baseball. But my hat's off to the baseball guys. Erik, it was great to have you on. Thank you. We're becoming a
Thanks for
great
having me.
firm, great history, obviously on the life insurance side, but talking about the investment management piece is cool. Thank you for being on today. I appreciate it, buddy.
Absolutely.
All right. Everyone have a wonderful weekend. And listen, avoid the headlines. Turn off if you want to watch the news because you're worried about what's happening there on a personal standpoint, great. Don't let it affect your portfolio. Don't let it affect economics. In fact, do what we do. Do what Erik and I do. When markets sell off irrationally, we take advantage of it. And hopefully we get to do it for you. And I think that's how you got to look at it. Don't panic. Take advantage of market imbalances because they don't last very long. Have a safe weekend. Enjoy yourself, everybody. Talk to you all real soon.